Your credit score can determine whether you are approved for an apartment, how much interest you pay on a car, and whether borrowing money costs you hundreds or thousands of dollars more. But here is the strange part. Most people are never clearly taught how that number is calculated. They receive alerts saying their score increased by 7 points or suddenly dropped by 20 points. Then they are encouraged to open another account, borrow more money, or pay for a credit monitoring service. But what actually controls your credit score? And can you build excellent credit without paying unnecessary interest? In this video, we will expose the 5 major factors behind a FICO credit score, identify the factor that matters most, and explain which popular credit-building advice could actually hurt you. Welcome to Wealth Compass. First, it is important to understand that you do not have only one universal credit score. Different lenders may use different scoring models, versions, and credit report information. The score you see through a banking app may not be identical to the score used by an auto lender or mortgage company. However, many lenders use versions of the FICO scoring system, which generally evaluates 5 major categories of information. Those categories are payment history, amounts owed, length of credit history, new credit, and credit mix. Let's begin with the largest category. Payment history generally represents 35% of a FICO score. In simple terms, lenders want to know whether you pay your financial obligations as agreed. A long record of on-time payments suggests that lending money to you may involve less risk. Late payments, collections, charge-offs, and other serious delinquencies can damage that record. This is why protecting your payment history is one of the most important credit decisions you can make. Set reminders before your due dates. Consider automatic minimum payments as protection against accidentally missing a bill, then pay the full amount you intend to pay separately. Automatic payments are not a substitute for monitoring your account, but they may protect you from forgetting an important deadline. The next major category is amounts owed, which generally represents 30% of a FICO score. This category considers several aspects of your debt, including how much revolving credit you are using compared with how much is available. Imagine that you have one credit card with a $10,000 limit. If the reported balance is $9,000, you are using 90% of the available credit. That can make you appear financially stretched, even if every payment has been made on time. If the reported balance is $1,000, you are using 10%. The lower balance generally indicates that you are less dependent on the available credit. This relationship is often called credit utilization. But there is an important distinction. You do not need to carry a balance from month to month or pay interest to demonstrate responsible credit use. You can use a credit card for an ordinary purchase, allow the activity to appear on the account, and pay the statement balance by the due date. Carrying debt and paying interest does not automatically improve your score. Responsible account management is the goal, not making the lender richer. The third category is the length of your credit history, which generally represents 15% of a FICO score. Scoring models may consider the age of your oldest account, the age of your newest account, and the average age of your accounts. This helps explain why closing an older credit card can sometimes have unintended consequences. Closing the account may reduce your total available credit immediately. Over time, it may also affect the age-related information in your credit profile. That does not mean every old account must remain open forever. If a card charges an annual fee, encourages overspending, or creates a security concern, closing it may still be reasonable. But do not close your oldest account simply because you have finished paying it, without first understanding the possible effect on your overall credit profile. The fourth category is new credit, which generally represents 10% of a FICO score. When you apply for a new credit card or loan, the lender may perform a hard inquiry. A hard inquiry may reduce your score by a few points, depending on the rest of your credit profile. 10% off today, associate. Opening several accounts within a short period can suggest increased financial risk. This is why applying for multiple retail cards simply to receive small checkout discounts may not always be a smart decision. The temporary discount can feel rewarding, but every new account adds another payment date, another opportunity for fraud, and another temptation to spend. FICO states that inquiries may remain on a credit report for 2 years, although its scores generally consider inquiries from the previous 12 months. The final category is credit mix, which generally represents 10% of a FICO score. Credit mix refers to experience managing different types of accounts such as revolving credit cards and installment loans, but this is where people can make a costly mistake. You should not take out an unnecessary car loan, personal loan, or mortgage simply to improve your credit mix. Credit mix is only one part of the score. Paying interest for years just to chase a few possible credit score points is not a sound wealth-building strategy. Your credit score should serve your financial life. Your financial life should not serve your credit score. Now let's address one of the most common questions: what score should you aim for? Instead of becoming obsessed with achieving a perfect number, focus on building a strong credit profile, pay every account on time, keep revolving balances manageable, apply for new credit only when it supports a real financial purpose, maintain older no-fee accounts when doing so remains practical, review your credit reports for errors and unfamiliar accounts. Your credit report contains the information used to calculate your score, but the report and score are not the same thing. You can review your official credit reports through annualcreditreport.com. Checking your own report does not damage your credit score. Look for accounts you do not recognize, incorrect balances, late payments reported in error, and personal information that does not belong to you. If you find an error, follow the official dispute process with the credit reporting company and the business that supplied the information. Now imagine two people. The first person has 5 credit cards, carries balances on all of them, and pays hundreds of dollars in interest every month because they believe debt is required to build credit. The second person has 1 or 2 accounts, pays on time, keeps balances low and avoids unnecessary interest. The second person may build strong credit while preserving more money for savings and investments. That is the real objective. A high credit score can help you qualify for better terms, but a credit score is not the same as wealth. Someone can have excellent credit and no emergency savings. Another person can have a large investment portfolio and choose to use very little credit. The score measures information in your credit history. It does not measure your income, investment balance, discipline, or total financial success. So, what actually controls your credit score? Payment history generally carries the most weight at 35%. Amounts owed generally represent 30%. Length of credit history represents 15%. New credit and credit mix generally represent 10% each. These percentages are general guidelines. The exact effect of any action depends on the complete information in your credit profile and the scoring model being used. Your most powerful strategy is not searching for a secret credit hack. It is consistently paying on time, managing balances carefully, applying only when necessary, and reviewing your reports for accuracy. Now tell us in the comments, which credit score factor surprised you most? Payment history, amounts owed, account age, new credit, or credit mix? If this video helped you understand the credit score game, please like it, share it with someone trying to improve their credit, and subscribe to Wealth Compass. In the next episode, we will expose how a $700 car payment can quietly prevent someone from building wealth, because wealth is not built overnight. It is built one intentional decision at a time. Your money needs direction. Let Wealth Compass help you find it.